Welcome to the Deep Dive. We're here to cut through the noise, go beyond the headlines, and really get into the details you need.
That's right. And today, we're tackling a really interesting one. It's ARB IoT Group Limited, ticker ARBB on the NASDQ.
And the data we're using is current as of September 2025.
Exactly. And this stock, well, it presents a stark choice, doesn't it? It's almost a binary bet.
Binary is the perfect word. You've got this history of, frankly, pretty severe financial problems.
Oh, no. Serious distress.
But then there's this promise, this potential future of just explosive growth. It forces you to pick a side.
Absolutely. And the hook here, the thing that makes it so compelling, is the sheer mismatch in scale.
Right. We're talking about a microcap company. I mean, its entire market value is floating somewhere between, what, $8 and $11 million? Tiny.
Just about, yeah. Tiny in the grand scheme. Yet they've recently announced these AI server contracts.
And the total value?
Nearly $100 million.
Yeah. Okay, let's pause there. 8 to 11 million market cap, 100 million in contracts. That's wild.
It really is. The contracts are roughly 12 and a half times the size of their entire revenue from last year, which was only about 8 million.
So the central question we have to tackle today is, can a company this small, with a track record of deep unprofitability,
Negative margins, yeah.
can they genuinely pivot and become this AI powerhouse based on deals that just dwarfs their current size?
It's the ultimate gamble. It's either going to be a spectacular success story or, well, a complete flameout. There's not much middle ground here.
Okay, let's dive in. We need to build the foundation first. Chapter 1, business analysis. Where did ARBB even start?
Right. So originally they were positioned as a full turnkey IoT solutions provider. Think Internet of Things.
Focused where?
Primarily the ASEAN region, Southeast Asia. They had several segments initially. IoT smart home and building stuff.
Oh.
IoT smart agriculture. They were doing some interesting things there, like hydroponics, even AI-powered fertilizer robots, apparently.
Huh, advanced stuff.
Yeah, and also IoT system development, plus a pretty big IoT gadget distribution network. They mentioned like 2,800 resellers just in Malaysia.
So fairly diversified in the IoT space. But that's not the story now, is it? The big shift.
Not at all. The real story is this dramatic pivot into a fifth segment, IoT AI server solutions.
And these are their own models.
Yeah, the ARB 222 and ARB 333 models. They're designed for, let's say, mid-range AI tasks. Not the super high-end stuff, but still significant.
And this pivot isn't just dipping a toe in the water. It's driven entirely by those massive contracts you mentioned.
Precisely. That $45 million order to a company called Gaja Capital.
Right.
And then another deal worth around $53 million. Boom. Suddenly they're players in this high-demand AI server space.
And in a hot region, too, ASEAN IoT and AI, those markets are projected to grow fast, right?
Very fast. Depending on the segment, estimates range from 15% up to maybe 33% compound annual growth rate. Huge potential.
Okay, potential is one thing. Reality is another. What's the competitive landscape like? It can't be easy.
Oh, it's brutal. It's incredibly fragmented. You've got local system integrators fighting for deals, but you've also got the global behemoths, Cisco, AWS, Microsoft. They're all active there.
Big players. And what about other hurdles?
Well, there are significant external barriers. Infrastructure, for one. You might get blazing 5G in a city like Kuala Lumpur.
But out in the countryside.
Exactly. You could be dealing with old 2G networks. Makes rolling out consistent IoT solutions tricky. Plus, navigating the regulations is complex things like Malaysia's data privacy laws, the PDPA, or Singapore's Cybersecurity Act. It's a minefield.
So for a tiny company like ARBB, what's their edge? What's their competitive moat, if they even have one?
Yeah. Moat might be generous. They obviously lack scale. Their main advantages seem almost historical.
Like what?
Well, their connection to the parent company, ARB Berhad, probably gave them some initial credibility. They do talk up their in-house R&D. And crucially, they have that existing distribution network in Malaysia, those 2,800 resellers. That's something tangible.
Could they lock customers in?
Maybe. If they really nailed the whole turnkey integration thing, hardware, software, support, everything, they might create some moderate switching costs, but it feels tenuous. It's not a deep, wide moat.
Tenuous indeed. That seems like a good transition to the people running the show. Let's talk Chapter 2, Management Evaluation. The CEO is Dato Srilu Kokleong. What's his story?
He's interesting because he apparently has a track record of exactly this kind of drastic change. He's credited with turning around the parent company, ARB Berhad.
How so?
Took it from what was described as an inactive timber segment, so literally logging,
Wow, okay.
and pivoted into a dynamic technology solution service. So he's clearly comfortable with massive strategic shifts. He's done it before, at least once.
Okay, so he's not afraid to shake things up.
Yep.
But if he's got this turnaround magic, why did ARBB get that NASDAQ warning, the minimum bid price deficiency in June 2024? That doesn't exactly scream competence.
That's the contradiction, isn't it? It's a huge red flag, a sign of real trouble.
So what did they do about it? How did management respond?
Well, they went for the quick fix, the mechanical solution. They executed a 1-for-15 reverse stock split. That was in June 2025.
Ugh, reverse splits. Investors hate those.
They do, and rightly so, usually. While it technically got them back into compliance with NASDAQ's rules, it's almost always seen as a sign of fundamental weakness. It suggests the stock price couldn't hold up on its own merits.
So a cosmetic fix, maybe. What about their actual strategy with money, capital allocation?
It's all in on growth, aggressive, high-stakes growth. Every bit of capital seems directed towards funding this AI server pivot and maybe some future M&A.
So no dividends, no share buybacks for investors.
Definitely not. All resources are going into the transformation attempt. But this brings us to a really critical and frankly alarming financial metric, return on invested capital, or ROIC.
Okay, what does that tell us?
It tells you how effectively they're using the capital they already have. And ARBB's reported ROIC is, well, it's deeply negative, somewhere between -24% and -30%.
-24 to -30%. What does that actually mean?
It means that for every dollar they've invested in the business recently, they've essentially destroyed about a quarter of its value. Their current operations, pre-pivot, are value destructive.
Ouch. So this AI pivot isn't just about finding growth, it's about stopping the bleeding. They have to make this work.
Absolutely. It's about reversing a really bad trajectory.
All right, the management picture is mixed, let's say. Bold vision, questionable recent execution. Let's see if the numbers back up any optimism. Time for Chapter 3, financial analysis.
Yeah, let's get into the weeds. And remember, we're starting from that tiny microcap base, $8 to $11 million market cap.
Okay. What about revenue? You mentioned $8 million last year, but what's the history?
Extremely volatile. It's a real boom and bust cycle. Get this. Revenue exploded by over 780% in 2022, hitting about $100 million.
Wow. Okay, that's huge.
But then, just 2 years later, in 2024, it plummeted 76%, right down to that $8 million figure.
So that huge 2022 number must have been based on some big one-off projects or something. Not sustainable business.
That's exactly what it suggests. Large, non-recurring deals.
Yeah.
And then nothing to replace them. Now let's talk profitability, or rather the lack of it.
Yeah, you mentioned the negative ROIC. What about margins?
It's pretty grim. The trailing 12-month, or TTM, gross margin is -18.7%, deeply negative.
Wait, gross margin negative?
Yes, that means the cost of the goods they sell the servers, the gadgets, is actually higher than the revenue they get from selling them.
So they lose money on every single sale, even before paying salaries, rent, R&D, anything.
Precisely. It's fundamentally unprofitable at the most basic level right now, and it flows down, obviously.
Yeah.
TTM net loss is around $14.2 million. Their net margin is -58%.
Good grief. Are they just burning through cash then?
They are. TTM cash from operations is -$5.9 million. So yes, significant cash burn.
This sounds like a disaster waiting to happen. Is there anything positive in the financials?
There is one crucial counterbalance, and it's likely the only reason they can even attempt this massive pivot.
Okay, what is it?
Their balance sheet is surprisingly clean, specifically regarding debt. They are effectively debt-free. Debt-to-equity ratio is 0.000.
Zero debt. Okay, that's unexpected.
It is. And their short-term liquidity looks okay, too. The current ratio is 2.02, which suggests they can cover their immediate liabilities.
So they have this cushion, this sort of financial runway, provided by the lack of debt.
Exactly. It's the war chest, however small, that they absolutely need to fund this AI strategy. Without it, they'd likely already be bankrupt, given the cash burn.
Okay, so how does the market value this strange mix? Losses, cash burn, but no debt, and this huge AI potential.
Well, traditional price-to-earnings PE ratio is useless because they have no earnings, only losses.
Right.
But other metrics tell a story of deep skepticism.
Sure.
Price-to-sales PS is incredibly low at 0.34. Price-to-book PB is even lower at 0.16.
0.16 price to book. So the market values the company's assets at only 16 cents on the dollar compared to what's reported on their books.
That's right. It signals profound doubt about the actual value or future earning power of those assets. The market is pricing in a high probability of failure.
What about trying to figure out an intrinsic value, like using a discounted cash flow model, a DCF?
You can try, but the model becomes incredibly sensitive to your assumptions. It forces you into that binary outcome we talked about.
How so?
To get any meaningful positive value, you have to make extremely aggressive assumptions. You basically have to model in the perfect execution of that entire $100 million contract pipeline.
Assuming it all converts to revenue and profit.
Exactly. And even then, because the risk is so astronomical, the volatility, the negative earnings history,
Yeah.
you need to use a very, very high discount rate, maybe 15%, maybe even 20% or more
Yeah.
to account for that risk.
So what happens in the model?
Either it spits out a potentially huge intrinsic value if you believe the miracle happens,
Mm-hmm.
or if you assume they fail to execute and keep burning cash.
Then the value crashed.
It crashes right down towards that tiny book value, or maybe even lower. It really just reflects the all-or-nothing nature of the bet. It hinges entirely on your belief in that transformation.
Okay, that makes sense. It's all about confidence, or lack thereof. Let's shift gears then and look at how the outside world sees this. Let's move into part 2, external forces and risk.
Right, we'll cover market sentiment, ownership, risk, and then try to pull it all together.
Perfect. Starting with chapter 4, market sentiment. Now, given the terrible financials we just discussed, you'd expect analysts to be pretty downbeat, right?
You would expect that, logically. But the analyst coverage that exists is actually, well, it's remarkably bullish.
Sure.
Shockingly so.
Really, what does it say?
Okay, coverage is extremely limited. It looks like just one analyst, but that analyst has slapped a strong buy rating on the stock.
A strong buy on this.
Yep. And get this, the average one-year price target is $20.40.
$20.40. What's the current price, roughly?
Well, given the market cap and reverse split, it's probably trading in the low single digits, maybe around $4 or $5 after that 1-for-15 split. So $20.40 implies.
That's over 300%, maybe 320% upside potential. How on earth does an analyst justify that, given the fundamentals?
It absolutely hinges on assuming perfect execution of the AI plan. They're essentially modeling the bull case scenario we just discussed, that $100 million happens, margins improve dramatically, and the company transforms. It's pure blue sky thinking.
So taking management's promises at face value, basically, ignoring the recent stumbles like the NASDAQ warning and reverse split.
Pretty much. The media narrative reflects this split personality, too.
Yeah.
You see these glowing press releases about the AI contracts, contrasting sharply with the fundamentally negative corporate actions. It's confusing.
What about other market indicators, like short interest? Are people betting against it?
Here's another puzzle. Short interest is actually remarkably low, less than 1% of the float.
That doesn't make sense either. If it's so risky, why aren't shorts piling in?
Well, it's probably not a sign of bullishness. It's more likely about the practicalities. Shorting illiquid microcaps like this is really difficult and risky in itself.
How so?
They can be incredibly volatile, huge price swings on low volume, and it can be hard to even borrow the shares to short them in the first place. The low short interest likely reflects those difficulties, not a belief in the company's success.
Okay, that makes more sense. And technically, the chart...
Well, the chart looks bad. Clear long-term downtrend. It's trading way below its 200-day moving average, which was around $7.59 pre-split adjusted. The momentum is definitely bearish based on price action.
All right, so analysts' optimism seems detached from reality, short interest is misleading, and the chart looks weak. What about who actually owns the stock? That often tells a story. Let's look at Chapter 5, ownership structure.
Yes, and this chapter contains perhaps the most telling and, frankly, damning piece of information for anyone considering this stock.
Oh, what is it?
Institutional ownership. The smart money, the big funds, the professional investors.
What percentage do they hold?
It's practically zero. Institutions hold only 0.11% of the outstanding shares.
0.11%. That's nothing.
It's effectively a complete rejection. Professional money managers have looked at the financials, looked at the risks, looked at the story, and they've overwhelmingly decided to stay away. It's a massive vote of no confidence.
Wow, that speaks volumes. What about insiders? Management?
That's the complete opposite picture. Insider holdings are exceptionally high, about 31.85%.
Okay, so management has a lot of skin in the game. Who holds most of that?
It's heavily concentrated with the CEO, Dato Sri Leong. He holds about 27.1% himself.
So on the one hand, high insider ownership aligns management with shareholders. They want the stock to go up.
That's the positive spin, yes. Alignment of interest.
It also creates huge concentration risk, doesn't it? And with almost no institutions, who else owns the stock?
It's basically management and then the general public. Retail investors hold about 49.5% of the shares.
So it's insiders and a diffuse group of retail investors with no big institutions providing oversight or stability.
Exactly. That lack of institutional presence increases potential volatility. It also means minority shareholders, the retail crowd, are potentially at a disadvantage if management makes decisions that benefit themselves primarily. There's less check and balance.
Okay, that ownership structure is definitely a red flag alongside the institutional absence. Let's try to wrap all these threads together. Chapter 6, Risk Assessment.
Right. Let's synthesize. We can use a simple SWOT framework: strengths, weaknesses, opportunities, threats.
Okay, strengths. We found a couple.
Yeah, the debt-free balance sheet is a clear strength. The CEO does have that history of a major turnaround, even if it was in a different sector. And they are positioned in these high-growth AIoT markets. Those are the pluses.
But the weaknesses seem overwhelming.
They really do. The severe ongoing cash burn, the massive, almost terrifying execution risk tied to delivering on $100 million in contracts when your revenue was $8 million. And that total lack of institutional credibility we just discussed.
What about external threats? Beyond the company's own issues?
Huge ones. Intense competition is constant from those global giants like AWS and Cisco, but also from specialized local players who might know the regional market better.
And you mentioned cybersecurity earlier.
Yes, that's a big one, especially in IoT and operating in Southeast Asia, which unfortunately has a reputation as a hotspot for cybercrime. A major breach could be devastating.
Makes sense. What about bigger picture macro stuff?
Extremely vulnerable there. As a company burning cash and needing growth, ARBB is highly sensitive to rising interest rates. That increases their cost of borrowing if they ever need it, and generally makes investors less willing to fund risky ventures.
And if the economy slows down?
That's bad too. Companies cut back on big tech projects during downturns, which could delay or cancel the very contracts ARBB is counting on.
Okay, one more risk factor. Geopolitics. You floated the idea of potential U.S. tariffs on tech from Malaysia or ASEAN in 2025. What would that do?
Oh, that could be a potential knockout blow, completely outside their control.
How?
Well, first, it could directly increase the cost of ARBB's hardware if they sell into the U.S. market, killing their margins. Second, it could massively disrupt their global supply chain for components like semiconductors, many of which pass through complex international routes.
Right.
And third, it could neutralize one of Malaysia's current advantages, being part of the China Plus One strategy, where companies diversify manufacturing away from China. Tariffs could negate that benefit overnight. It's a systemic risk that could derail the whole AI pivot, regardless of management execution.
Okay, a minefield of risks. Internal, external, macro, geopolitical. It brings us inevitably to our final section, Chapter 7, Conclusion.
Yep. Let's try to synthesize this whole complex picture. The core conflict is clear. ARBB is a highly speculative bet. You're betting on a radical, almost complete corporate reinvention.
Right. Summarize the bull case for us one last time. Why would anyone buy this?
The bull case is simple, but requires immense faith. It's a bet on the perfect, flawless execution of those $100 million AI contracts. And it's a massive if they pull that off.
Then what?
Then they completely reset their financial story. Revenue explodes. Hopefully margins turn positive, they leverage that debt-free balance sheet, and the stock price could, theoretically, skyrocket from its currently depressed levels because the starting valuation is so low. You're betting on the miracle.
Okay. Now, the bear case. The argument against.
The bear case is arguably much more grounded in reality and historical patterns. It's a bet that they fail to execute those huge contracts, or at least fail to execute them profitably. Then the negative margins continue, the cash burn accelerates, the lack of institutional support bites, and you're left holding shares in an illiquid, struggling microcap that might eventually face bankruptcy or delisting. It's a bet on the status quo, which is dire.
So when you boil it all down,
We have to be crystal clear. ARBB falls completely outside the realm of traditional value investing. You don't buy this for predictable earnings, a strong competitive advantage, or a margin of safety. None of that exists here.
so what kind of investment is it?
It's pure speculation. It's akin to a venture capital investment, but in the public markets. It's suitable only for investors with the absolute highest tolerance for risk.
People who understand they could lose everything.
Exactly. You must be prepared for extreme volatility and the very real possibility of a total loss of your invested capital.
Yeah.
This is not for the faint of heart.
Okay. So here's the final thought we want to leave you, the listener, with today. Given everything we've discussed, the CEO's history, the massive contracts, the terrible financials, the lack of institutional backing, the immense risks, what percentage chance do you personally assign to ARBB successfully executing this $100 million AI pivot?
Yeah. Weigh that execution risk against the potential reward. It's a fascinating if dangerous calculation.
If you found this deep dive into such a high-stakes situation helpful, remember to like and subscribe to Stock Analytics AI.
That's right. And our members, it's just $4.99 a month, get priority deep dives. We're actually planning to cover all the S&P 500 stocks over the next few months, and members get first dibs on those.
And hey, if you just want a one-off analysis on a specific stock, you can always drop us a super thanks. We appreciate the support.
And the crucial final reminder, this analysis was generated by an AI system. It is for educational and informational purposes only. It should absolutely not be considered financial advice.
Please do your own thorough research before making any investment decisions.